Gold's only halfway the same metric move that it made twice before in the last 50 years. So figure that in. Even just to match those, you go 8,000 plus. Okay. Silver versus gold is very depressed historically. And it looks like it's on the edge. Technical breakout versus gold, which will get it back to normalities and probably to some high levels, which we're 1.24, 1.25% of the price of gold right now. Divide an ounce of D silver into gold. You end up at 1.24, 1.25. There's a spread breakout above 1.3%, not far above it. When you break out of that, that's when I set the clock on that 6-month issue. Not now. I'm waiting for that spread to break out. When that occurs, I'm arguing that in the next couple quarters, give or take, you're likely to see silver go berserk.
The precious metals complex has entered one of its most dynamic phases in more than a decade. Gold recently printed fresh highs after weeks of consolidation, while silver has quietly tightened into one of the strongest structural setups it has seen since 2010. Physical premiums in multiple regions are rising. COMEX inventories continue to trend lower, and Asian market demand, especially from China and India, remains relentless. The macro environment is adding fuel. Treasury yields are oscillating at levels that historically precede stress fractures in equities, and central banks continue accumulating gold at an aggressive pace. All of these are signals that the monetary metal cycle is maturing into a powerful new stage. Against this backdrop, Michael Oliver's work stands out because it isolates the internal structure of markets rather than surface-level price noise. Oliver argues that gold's next and most important move hinges not on sentiment or headlines, but on the behavior of the S&P 500. His spread analysis, gold measured against the S&P, shows that gold is pressing against an 11-year structural barrier on a relative basis. If gold closes above this long-term spread ceiling, Oliver believes it marks the beginning of a major asset class rotation, a shift out of concentrated equity leadership and into hard monetary assets. According to him, this moment is not about gold looking overbought. It is about the S&P relative trend turning decisively in gold's favor for the first time since 2011. From that foundation, Oliver transitions into the metal that he believes carries the most dramatic upside, silver. He notes that silver's relative performance against gold has been locked in a downward staircase since early 2021, but that pattern is tightening into a structural ceiling. Break that ceiling, and specifically break above the 1.3% spread level, and the clock starts on what he expects to be a violent repricing phase. This isn't simply a bullish call, it is a structural argument grounded in historical behavior. When spreads break out, markets move, and for silver, a breakout would signal the beginning of a long-awaited normalization after years of suppression, disinterest, and mispricing. In a moment, we'll break down Oliver's deeper analysis of silver's technical position and what a legitimate breakout could mean for miners and long-term investors. Before that, please make sure to like this video, share it with fellow investors, and subscribe so you never miss a major update on gold, silver, and global markets. We appreciate the support and hope you enjoy the video.
We ran studies over the last month in our weekend reports where we looked at copper, for example, back to 1980s, 70s, 80s, 90s, 2000, 2005. Copper was in a dead range, or in a range. It's where it lived in. It was this reality. Up and down, just like sort of silver's done for 50 years. $50 down, $50 down. Now we're tangling with 50 area. But when copper came out of that range in it was late 2005, early 2006, it quadrupled in price in a couple quarters. And hey, new reality. It didn't incrementally go from 1 to 4 level. Okay. It did it in a couple quarters. And then, yes, it's a violent sell-offs, but at levels that are now 4 times the height, 4 times the average price of that decade, multi-decade range that prevails in 80s, 90s, 2000, etc. And then we looked at lead, exciting market. It did the same thing. It was in a dead range, 70s, 80s, 90s, 2000. And in 2007, it broke out its old reality, and it quadrupled in price in a couple quarters. Not coincident with copper. That was a year prior. Lead did it. And then lead has lived in a zone of reality, a new level that's 4 times the price level of that zone of reality back then. Okay, now, Look at gold. The mama market was silver, monetary metal, monetary metal. Gold made a high at 850 in 1980, made a high at 1920 in 2011. It was up in the mid 4,000s. Okay, what's silver done? 50, 50, 50 area. What's going on? What's restraining it? Well, it's not an issue. There are arguments that are solid that it's been manipulated. We know there's even been some convictions in that regard. But we also know that when you try to distort reality by artificially suppressing something, talk about even when governments try to do it, because they can't withstand ultimate market pressures. When it unleashes in a tantrum. Now, we all know in hindsight, investors with any maturity do, that markets make bubble tops, like the stock market, like the .com or the mortgage crisis was building from 2005, 6, 7. Market ignored it, didn't care. And finally, when it cared, it fell apart, but ignored reality. And therefore, another bubble top, or 29 was a bubble top, 23 to 29, then collapsed 80% by 1932. We all know in hindsight, markets make excess on the upside, but they also make excess on the downside, where maybe a market goes down hard, but maybe too hard, and it lays there dead for a couple of years, and investors just pass it by because, heck, it's nothing going on, right? Just ignore it, forgetting, of course, that it's dirt cheap. And when it wakes up, suddenly it's like a thunderbolt. It's not like a little creepy crawly thing. It's quite common. Well, we're arguing silver's in that same position of moving into a new reality, has all the reasons. Plus, we have a bull trend. Silver's in a bull trend. Gold's in a bull trend. And when we measure certain other metrics, not just look at the simple price chart, which everybody does, and every time there's a $3 drop in silver, it's the end of the world. I buy into them. Okay. If you measure, for example, the monetary metal mama, gold, versus the S&P 500, in 2011, when gold peaked, it came down in price, and it really came down in 2013 into 2015. 2013 was its real bad year. And during that time, if you measured gold owning it versus the S&P, you were a loser. Gold was losing value to the S&P. But starting at the 2015 low, when gold made its low at $1,050, if you plotted the spread, divide the front month COMEX contract of gold into the S&P, and plot it month by month. Where's that spread? What percent of the S&P price is gold? You got a chart, okay? You could draw a line sideways for the last 11 years, in fact, going back to 2014, where relative performance of gold has really been on either side of that low we saw in 15. But there's also on that chart, over 11-year period of time, you can catch 1, 2, 3, 4 different highs where gold rallied on a relative basis to the S&P, which meant also gold was rallying price, but on a relative basis, it shows up on the chart. And you created a perfect trend structure, almost flat, slightly declining structure on the spread that says if you get above this line, you're breaking out versus the S&P. Right now, we're at levels. If you close the month today, you're breaking out. Okay. Now, when that spread breaks out, again, remember, it's an 11-year wide base. It's saying something just began. Asset class movement from gold out of the S&P is just commencing. You just crossed the starting gate. So if anybody who's arguing, gold's too old or it's RSI is too high, that spread chart says you don't even know the game is just beginning. Massive asset class shift. Similar structure exists on silver versus gold, where we know that silver is still in that range and gold is going up, multiples. When you plot a spread on that, let's say go back to 2020, for example, when silver had an explosive up move, remember, starting about in March through late that year, silver doubled in price, gold went up about 40%. So silver outperformed gold. But since that peak in early 2021 for silver, its relative performance has staircased down. And it also built a flat range top where there was the spread had a rally and bumped the level, backed off. Silver rallied versus gold, stopped at a given level, backed off. You're now pressing back toward that level for a third time, meaning the spread chart has a breakout level not far above. And if you cross that level, divide an ounce of silver into an ounce of gold, express it as a percent. When you cross that level, that spread chart says silver's going to beat gold. Okay, put those two contexts, the two things together. Gold's about to shift out versus the stock market. By the way, gold's already broken out versus the Dow going back 10, 11 years and versus the New York Composite, which are broad indices. They're not front-end loaded with 2, 3 AI stocks, okay? It's already broken out versus them. We're waiting on the S&P breakout versus gold versus that. But when that happens, it looks like the silver-gold spread is also on the cusp of a breakout.
Silver's position today is unusually similar to other commodities right before they launched into new multi-decade realities. For nearly 50 years, silver has remained trapped between breakout attempts, corrections, and long plateaus that discouraged mainstream participation. Yet the structural pressure beneath the market has not disappeared. It has compounded. The tightening of the silver-gold spread, the contraction of accessible inventories, the renewed industrial demand driven by energy and technology transitions, and the resurgence of monetary demand are converging at the same moment. Oliver's work suggests that once silver exits its long-term range, just as copper did in 2005 and lead did in 2007, the move will not be incremental. It will be violent, abrupt, and reprice the market in a matter of quarters, not years. More importantly, silver miners stand at the edge of what could become one of the strongest performance cycles in the sector since the early 2000s. They have been heavily discounted, underowned, and largely ignored by institutions for over a decade. Meanwhile, capital expenditures have shrunk, grades have deteriorated, and new discoveries remain scarce. When silver reprices upward and the spreads confirm a new trend, miners tend to outperform the metal itself. Oliver's bullish posture on silver is deeply tied to this dynamic. Monetary tightness, structural supply constraints, and a spread chart on the verge of breakout, together pointing toward an environment where silver's upside is potentially explosive.
If you go back to when gold was legalized by the government in 1975, and you look at the prior bull markets that occurred in that 50-year period, one took us from a low, in the 76 low was about $103. It dropped from 200 down to 103, 75 to 76. And in the next 3.5 years, gold went up eightfold, $103 to $850, okay? 1980. Then in 2000, 2001, gold was bottoming at around 260, repeatedly, quiet bottom. Wasn't going back to $50 again, back to 100 or even back to 200. It was at 260, okay? When it turned up, it went to 1920, took it a decade, longer time span, another eightfold move, okay? Now, we have more fundamental dynamics now and technical dynamics than we had either of those times. So to expect it to just go an eightfold move is probably a mistaken notion, but even go eightfold means gold's going to go in the mid-8,000s. Why? Because our bear low was 1,050. We're only halfway logarithmic dimension of those prior two bull markets. So everybody says it's overdone. It's only half as much as those prior two bull markets when you do a ratio scale, price to price advance. What percent gain did you make? So gold is only halfway, even just getting to the norm of an eightfold move. And I doubt it'll stop there. But even if you have an eightfold move, I mean, that's doubling from current levels. And that would shake the world as well. And no doubt there would be reasons for that people would look back and say, aha, now I understand why, And some of those reasons are starting to come into place right now. Gold's only halfway the same metric move that it made twice before in the last 50 years. So figure that in. Even just to match those, you go 8,000 plus. Okay. Silver versus gold is very depressed historically. And it looks like it's on the edge. Technical breakout versus gold, which will get it back to normalities and probably to some high levels, which we're 1.24, 1.25% of the price of gold right now. Divide an ounce of D silver into gold. You end up at 1.24, 1.25. There's a spread breakout above 1.3%, not far above it. When you break out of that, that's when I set the clock on that 6-month issue. Not now. I'm waiting for that spread to break out. When that occurs, I'm arguing that in the next couple quarters, give or take, you're likely to see silver go berserk. Gold's going up too, but silver go berserk, net price-wise and relative to gold. Catch up for old realities they've been stuck in, unjustifiable. It made a mistake. Maybe it was imposed from above, but it made a mistake. And when it wants to reprice itself, it won't do it gently. It'll do it in a thunderbolt. I think we're on the cusp of that. The other thing to watch is gold versus S&P. Again, we put these in every week. We issue these updated charts. When those two things break out, I pound the table and say, if you're an investor, shift your mentality out of the stock market into gold. Even if you don't think the stock market's going down, fine. Okay. Gold's going to beat it regardless. Because when that spread breaks out, it is a huge technical event. And nobody's talking about it. All they're talking about, gee, gold's overdone. You don't know what's overdone. There's other factors out there, like you mentioned, monetary reset. Fiat currencies have not worked. They've created ongoing debt, ongoing monetary growth. Government uses these pieces of paper to do what they want to and print the money. And the consumer, the average guy, has to pay for it in the sense that the dollar in his pocket 10 years ago is worth half what it is. When your dad built a house, it was your granddad built a house, $4,500. Your dad built one, $45,000 medium home price. Now it's $450,000. That's what I mean by degradation of the money unit. So the fact that the S&P's gone up, like if you go back to 20, 25 years, pick the same month, November, S&P's gone up, what? As much as the money growth. It really hasn't beat the money growth, M2 growth. Gold's beat it handily. Nobody acknowledges that. Yeah, there's ups and downs, but the issue is to protect yourself from the con game of that piece of paper or the euro or the yen, same story. And now we have a government debt crisis in the UK, in Japan, here, when the Fed has to say, we're going to step in and buy the bonds. Oh, it's only because of liquidity. No, it's not. The market is in trouble. And if it starts down, the world ends. It's bigger than the stock market. It starts down, the upper yields. And we're watching the T-bonds very closely, and they're not far above levels, which if they roll over again, this time it's going to be a headline type story. And it's too big for the stock market to ignore. It's the kind of thing that'll derail every assumption you've got about the stock market. And do what? Cause the central bank to go ape. That's blood for gold. Gold's ongoing trend is to keep its value. It always does. Decaying money over decades, no problem. Gold holds its value. Very little else does. And that's what's really going on here in the big picture.
Michael Oliver's most powerful conclusion is that both gold and silver still have a long runway ahead. Gold, by his calculation, is only halfway through the kind of logarithmic move it achieved during its two prior major bull cycles in the last 50 years. Those cycles produced 8-fold increases from trough to peak, and gold today has retraced only about half that relative distance. For gold to simply be in line with its historical bull market behavior, prices in the mid-$8,000 range are mathematically consistent with precedent. That projection alone would upend conventional asset allocations, challenge equity dominance, and shift trillions of dollars in capital flows. But silver, in Oliver's view, is where the true asymmetry sits. Silver's relative depression against gold is not just extreme, it is historically unjustifiable. A silver-gold spread breakout above roughly 1.3% would signal the beginning of a fast, disorderly repricing phase. Oliver has repeatedly compared this kind of setup to commodities that remained dormant for decades, only to explode fourfold in a matter of quarters once their ranges broke. Silver's suppressed performance, years of industrial underpricing, and a global monetary backdrop heading toward a multi-currency reset all reinforce the likelihood that its next move will be far more dramatic than gold's. This is why Oliver openly states that he is more bullish on silver and silver miners than on gold. Another critical element Oliver highlights is the broader monetary environment. Fiat currencies across the world have been weakened by years of aggressive monetary expansion. Gold has already outpaced money supply growth, while equities, especially the S&P, have largely tracked it. Investors often celebrate new S&P highs without acknowledging that those highs merely reflect the degraded purchasing power of the underlying currency. When viewed through this lens, gold's breakout versus major equity indices is not a sign of speculation, it is a sign of capital preservation. And silver, as the more volatile monetary metal, tends to accelerate once this kind of revaluation process begins. The final dynamic Oliver emphasizes is the systemic fragility in sovereign debt markets. Rising yields, weakening liquidity in long-duration treasuries, and increasing government debt burdens create a scenario where central banks must intervene more aggressively each cycle. Every intervention reinforces the long-term case for hard monetary assets. When the next bond market dislocation emerges, and Oliver warns that it is not far away, gold and silver are positioned to become the primary beneficiaries. Monetary metals have always thrived in moments when confidence in debt structures falters, and the spreads are already signaling that capital is preparing to move. If you found this analysis valuable, make sure to like this video, share it with fellow investors, and subscribe to the channel. Your support helps us reach more people who want real analysis, not noise. Thank you for watching, and stay tuned for more deep dive coverage of gold, silver, and the global financial system.